Hey everyone, me Kevin here. So here's the latest on catalysts that we should be looking at this week. So I'm going to talk first about a new catalyst that just came in, and then I'm also going to talk about future catalysts for the rest of the week. So if you are watching this in the week of April 12th, whether it's Monday, Tuesday, Wednesday, Thursday, Friday, it's probably got something for you to watch. All right, so here we go. Today, we just got a new survey of consumer expectations for inflations out, or for inflation, not inflations. And what's neat about this is it kind of gives us a forecast of how high individuals or consumers actually think the consumer price inflation or consumer price index is going to go. And this is unique because what we're trying to understand is not just what inflation is last month, but what inflation might be month after month after year. The reason for that is Jerome Powell tells us that inflation trends are going down, that inflation dynamics are going down, and that a lot has to happen to sort of de-anchor us from being in an environment of 1% inflation. Well, if consumers are starting to expect higher inflation and they continue to hold that expectation year after year, this could be a leading indicator for bigger inflation coming. And folks, the survey just came in, and this survey says that our expectations for inflation over the next few years hit their highest levels in March, which was just reported, since March of 2014, with expectations for surging costs, especially in housing. Now, expectations for March of those people who were polled came in at 3.2% inflation a year from now, and 3.1% inflation 3 years from now. Both of these readings were up a tad. I think it was 0.1% from February. And survey respondents, when they were asked, also assumed that there would be higher incomes and higher spending going forward, but that they did believe inflation would come in at 3.2% a year from now and 3.1% 3 years from now. That goes really counter to what the Fed has believed, that inflation would go up to potentially around this 2.5% to 3% level, and then just modestly come back down and kind of go back into the bottle. The genie will go back in the bottle, so to speak. The Fed believes, hey, look, if inflation goes up 3.5%, 2.5%, and then settles back down at 2.4, 2.2, we'll raise rates a little, and we'll get that right at that perfect, beautiful 2% number. Well, if consumers are expecting inflation's actually going to be 3.2% and then 3.1% 3 years from now, Fed might be unfortunately mistaken here, and we might see a lot more pain coming from when the Fed has to react to raising rates faster. Now, we'll see who's going to end up being right, consumers or the Fed. All right, now let's look forward. So that is the data that already came out, that just came out. Now let's look forward at new data. So Tuesday morning, we will have CPI data, consumer price inflation, or consumer price index data, which measures inflation. There are generally two reads we look at. We look at the broad scope of CPI, and then we look at core inflation, which core is just basically the same basket minus food and energy. And so we're going to see what kind of month-over-month increases we had. That's where we really want to focus on. What we really want to see is that coming in as low as possible. Ideally something like, 1/3%. Because even 1/3% implies an annualized rate of inflation of somewhere around 3.5%. Because if you take 1/3, 0.3, and multiply it by 12, you get 3.6%. That's a lot, right? And we're expecting larger inflation, but what we're really paying attention to is how much did prices go up between February and March. And we want that number to be as small as possible. In February, so from January to February, we had the month-over-month data come in at 0.4. So we're hoping for something under 0.4. That would be good. If it's, if it's like 0.5, okay, all right, maybe we're kind of bracing for impact here anyway. If it comes in high, kind of like the PPI came in high, the producer price index, which came in at 1%, the market could get a lot more shocked. So we're not so worried about that year-over-year figure. You're going to see a lot of headlines. Oh my gosh, year-over-year inflation, 2.4, 2.5%, whatever. What we're really going to be interested in is that month-over-month figure. So that's what we're tracking. Tomorrow I will be live at 5:25 a.m. California time, and 8:30 a.m. or 8:25 a.m. Eastern time, so we can understand, okay, what happened, because that data will be coming up first thing in the morning. Now, at the end of this month, we'll also get the PCE, which is another way of measuring the consumer price index. It just includes some things that the CPI doesn't. This is actually the measure that the Fed uses. It includes things like medical care expenses paid for by employer-sponsored insurances or Medicare. We expect them to be pretty similar. CPI, because it's so much earlier than the PCE, is going to be the one everybody, I think, is paying attention to. Now, keep this in mind as well. Bloomberg is already reporting that inflation is already being priced into 12-month shipping contracts, and that's because a lot of companies are locking in 12-year contracts with shipping container prices between $2,500 and $3,000 per 40-yard container, or sorry, per 40-foot container. Now, that's substantially higher than how much a container usually costs to ship, which is around $1,500. It's somewhere around a chunk to twice as high. And this is exactly the kind of stuff that could end up leading consumer prices to go up, which as consumer prices go up, those shipping costs get passed on to the consumer. What do we have? Boom, inflation. We're already expecting to see hot growth this year, which adds to inflation as well. If we end up seeing 6.4% growth this year, by the way, we will end up having 2021 go down as just a handful of years that have grown this fast in a single year over the last 70 years. We used to grow at 6% more frequently, but in the last 70 years, it's not as common anymore to grow that fast. With growth coming in, or growth expectations coming in at about 3.2% for 2022, we do expect that combined 21 to 22 will be some of the highest growth we have seen since 2005. Which is not exactly a date or year that people in real estate want to hear. We don't want to make any connections to 2005. Anyway, so there's a little bit on growth, inflation, expectations, what consumers are expecting, and a catalyst coming out. On Wednesday, we have, so the day after the CPI data comes out, we have the Beige Book of Economic Conditions coming out on Wednesday. The Beige Book is just really a summary from the Fed of here's what's going on in the economy. We really don't expect massive surprises in this because we hear from the Fed so darn frequently. So probably not the biggest catalyst on a Wednesday. Then on Thursday, we get March retail sales and we get March industrial production. Both of those are going to be key. We want to see industrial production up a lot to try to help us alleviate these supply chains. Keep in mind, industrial production includes companies like MP Materials that make magnets and parts for motors. So think input costs for things like chips or motors or all these input sectors or utilities. That's what you're measuring with industrial production. We want to see that go up, 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 up. We really want more production so we can grease the wheels of this economic growth as much as possible, especially since we're expecting so much growth over this next year. We need all cylinders firing, basically. We don't want anything lagging. Then on Friday, we get housing starts. This is also going to be a highly looked after number. We want to see housing starts skyrocket, please, to help alleviate the madness that we are seeing in the real estate sector right now. We definitely want to eliminate some of this supply shortage, and one of the easy ways to do that is just building. Unfortunately, building does take usually about 2 years from start to finish. So there will definitely be a lag time, and that does mean we'll still experience quite a bit of a shortage for a while. Then we've got earnings for the rest of the week. We've got OGI coming at the top of the list for implied volatility with 26.2% with a Tuesday report. Fastenal will also be reporting on Tuesday with an implied 6.1% move. We do have Lovesac reporting Wednesday, but the bigger ones that we're really going to want to pay attention to are going to be the financials. We want to see the financials take off. We got Ally, we got Citizens Financial Group reporting. We've got First Republic Bank reporting. We've got BNY Mellon reporting. And these are going to be some of the big intros to our earnings season, just getting started here for Q1. So buckle up. It's going to be one heck of a ride. Obviously, the market is pricing in some insane growth and insane expectations. So, look at just the S&P 500. With the gains we've had over the last 4 or 5 trading days, we're trading at a pretty high relative strength index of the S&P 500. We are relatively overbought right now in the S&P 500, which going into earnings, Well, let's just say a lot of people are holding their breath. So here's a video full of catalysts for you to pay attention to. Hopefully this helps you out. If it does, consider subscribing. Folks, thank you very much for watching the video, and we will see you in the next one.